Hello everyone and welcome. In this video, we're going to talk about the basics of tokenization and why it matters to inclusive finance. My name is Jenik. I'm from CGAP and today I am joined by my colleague Sonia Arenaza. Together, we're going to talk about what is tokenization, why it matters, and what are some of the key points to remember and watch for. So, Sonia, why don't you tell us what is tokenization?
Thank you so much, Ivo. Let's start with what tokenization is. Tokenization enables sending value digitally. How does it do it? It turns real-world things into digital tokens that you can send, manage, and track on a blockchain. Tokenization and blockchain are general-purpose technologies that enable doing 24/7 around-the-clock real-time transactions. What can we tokenize? We can tokenize anything. For example, money. $100 fiat could be converted into $100 worth the value of stablecoins. Your house deed could also be tokenized. It's the ability to digitize real world things, real world assets, and bring them on chain. You could also tokenize your certificates, your diplomas, your driver license, or any verified credential like your KYC, and many more things. For example, financial assets, real world assets, and IP. The question isn't whether to tokenize or not to tokenize, but what to tokenize and why to do it. What's the case? What's the business case? What's the value proposition? The benefit is you can send tokens instantly, globally, securely, around the clock, the same way you send a message or an email. Now let's talk about type of tokens. We say that we can tokenize anything. So there are like two groups, digital money and tokenized value instruments, meaning assets that represent a monetary, financial, or investment property. And the second part is digital identity of verified credentials. You may have heard about Bitcoin, Ether, Sol. Those are native cryptocurrencies that have their own properties and that have their own price. Stablecoins, on the other hand, are digital currencies pegged to fiat. For example, to dollar, to a euro, to peso, and are issued by private companies. Central bank digital currencies, also known as CBDCs, are issued and represent a liability of a central bank. You may have heard about wholesale CBDC and retail CBDC. They have different purposes. Tokenized deposits are commercial bank deposits and are liabilities of a bank represented on a blockchain. There are different projects like, for example, JP Morgan, Citi, and many other financial institutions. Tokenized real-world assets, also known as RWA, are a digital representation of on-chain assets such as real estate, your house, a commercial center, or commodities, securities, bonds, money market funds, and tokenized treasuries. We said on the digital identity and verified credentials, you can say that you could tokenize your KYC, your driver license, your certificates. Yes, those are identifiers tied to individuals, entities, and represented on a wallet and are cryptographically signed. So how does tokenization work? We say that tokenization is a process that enables converting real-world things into digital tokens. So as part of this process, we have an input, a real-world asset, a $100 bill, your house deed, your driver license, and ID card. As part of the tokenization process, there is a creation of the digital token on a blockchain, and that's encrypted. The asset details, the ownership, rules of the assets are recorded and encoded, and the token now represents the asset that we could move, meaning that we could transfer, we can manage, we can store, and we can track those assets via wallet almost instantly, 24/7, around the clock. There is a transparent history. Anyone can verify those transactions. At the end of the day, what we are saying is the token becomes a digital vehicle carrying information and value on blockchain rails, making it movable, trackable, and programmable. This represents an enhancement, new rails, and plumbing for the financial system. Let's talk now about tokenization enablers. What makes it possible? First, wallets for access and custody, and second, we will talk about programmability. On wallets, we say that wallets will allow or enable access to the asset, will allow us to manage our keys, to store credentials, digital identity, digital money, and also value instruments as we discussed in the type of tokens. They will allow us to sign and authorize transactions and to interact with any smart contract if that's available. At the end of the day, the type of wallet that we receive, it's a design choice based on who will have control, what's the level of literacy. Wallets are tools for storing and managing those tokens. Let's talk about two key ones, custodial and non-custodial. The custodial is like a bank account. You're more familiar, their password is easy to reset, the institution must secure, they are the provider is responsible for it, and there is a low level of literacy required. On the non-custodial, it's like cash. You own it. You have a choice. You are empowered and controlled to do it. But if you lose your keys, you lose your assets. Second enabler, smart contracts for programmable money. What are smart contracts? They're self-executing agreements written in code. So those terms are agreed in advance and are written directly in code, into lines of code on a blockchain, and those are encrypted. The output of a smart contract becomes a token. Let's give some examples. Think about a conditional cash transfer. The money will be released, or the transfer will be released upon certain conditions are fulfilled. For example, completing a training or buying products that are allowed. Or an automatically debit from your loan on the due date. So your wallet will be debited. Or some triggers, triggering an insurance payout when conditions are met. For example, based on weather or a flight delayed insurance, etc. Why does it matter for us? Why we would use a smart contract? Because it reduces operational costs. It eliminates human errors. And it creates an audit trail. Remember that we talk about that blockchain enables or helps us with like transparency and traceability, and it also reduces involvement of intermediaries that make this process costly and inefficient. We have discussed about tokenization, the process, the type of tokens, the key enablers. Let's talk now about the ecosystem, stakeholders, roles, and the regulatory perimeter in which they function. The ecosystem brings new players to the traditional players. We have fintech companies, regulators, technology providers. And following the same process, if I would like to send money from country A to my family in country B, and if I have $100 bills, I need an exchange like Binance, Bitso, or Coinbase to convert that $100 bill into $100 equivalent of a token. And we have token issuers, Circle, Paxos, for example, and that token that represents value and information will move on rails, on blockchains. And you may have heard about Ethereum, Solana, Stellar, etc. Once I have that token that brings value and information, that will be, I can access, manage that through a wallet. And there are wallet providers. And if we're talking about sending money from country A to country B, in country B, my family will have the ability or should have the ability to and choice to have those tokens in a wallet or to cash out. And that's why we have on-ramp and off-ramp partners. So now, given that we have talked about examples like cross-border remittances and converting $100 into stablecoins because they are pegged to a currency like a dollar, euro, peso, etc., and provide certain stability and allows us to send value and information, let's double click on two key stakeholders, stablecoin issuers and exchanges. You may have heard about stablecoin issuers like Circle and Paxos, who operate on scale-driven reserve-based models, and exchanges like Coinbase that are like operate on trading volume. More trades, more revenue. And as you can see on this table, there are like differences in terms of like the revenue model, the success metrics, the user behavior that they expect, the sensitivity to interest rates. And on the regulatory focus, the stablecoin issuers, there is an emphasis on the transparency on the reserves because they are pegged to a currency, the auditability, and the redemption rights. On the exchange side, we have market integrity, the ability on the KYC and AML and custody rules. With that explainer about tokenization, now let me pass it on to my colleague Ivo, who will talk about why tokenization matters. Thank you.
Thank you, Sonia. Well, so does tokenization matter? Let's first acknowledge that tokenization is really new innovation and as such can take different directions, and we can only see in the future where its impact really is. But we can say that tokenization may be potentially very impactful as the future infrastructure for digital economy, where financial services are seamlessly embedded in non-financial activities. Tokenization can also help to improve the existing design and delivery of financial services and create new types of financial services, improving the cost of financial services, access to financial services, but also improving customer fit and experience, and also bringing competition to the financial markets. Investors, donors, policymakers, they're all increasingly taking interest in tokenization, signaling that it is real. And importantly, if tokenization is the future backbone of digital economy, then we need to make sure that it is inclusive, that we're creating a system that includes people, not as of today where 1.3 billion adults are financially excluded. Now, with some of those hypothetical premises, we also see that tokenization is happening. For instance, using stablecoins in cross-border remittances or as a store of value, using tokenization to create alternatives for collateral registries, or using tokens as collateral. With fractional ownership, using tokenization as a way to open up investment opportunities for retail mass market investors into the existing asset classes or new ones, using tokenization to create IDs and credentials. And some of the large international organizations are using tokenization to manage liquidity and perform treasury function. Now, while some of these use cases may be at early stages or as pilots, we also see significant traction in some areas of tokenization. The tokenized real-world assets have reached $30 billion in value and are estimated to grow to trillions in less than a decade. There are $300 billion worth stablecoins circulating as of November 2025, again estimated to grow to trillions by 2030. With almost 250 million unique addresses sending stablecoins. And so while this is happening, regulators all around the world are noticing and taking action to create level playing field and frameworks for tokenization to scale. From Australia to Japan, Hong Kong, Singapore, all the way to the United States, regulators are busy. So what are some of the important points to remember? First, tokenization allows for value and rights to move digitally, and as such can be the future infrastructure for digital economy. Number two, tokenization allows improvements and innovation in finance, lowering the cost of financial services, improving access to financial services, improving customer fit and experience. Number three, stablecoins are among the fastest growing use case in tokenization. And number 4, regulators are increasingly working on tokenization frameworks to create a level playing field. And with that, if you are interested in tokenization, stablecoins, and financial inclusion, you can follow us on cgap.org. Thank you.